that work with QBCC licensees. Welcome, it's great to see you here. We also have Nat Dennis-Weller, the manager for the financial assessment unit, here with us today, and Nat will be stepping you through requirements for trust entities for MFR reports. As always, we've got some great support behind the scenes. We have Joss from our education and engagement team, and we have Mel and Lauren from our financial assessment unit. My name's Harm and I'm with the education and engagement team, and I'll be Nat's assistant for the presentation today. Just before we begin, I would like to acknowledge the traditional custodians of the land I'm speaking to you from and pay my respects to their elders, past, present and emerging. I also acknowledge the traditional custodians of the lands on which each of you are living and working, and I extend that respect to Aboriginal and Torres Strait Islander peoples here today. Okay, a little housekeeping just before we get started. We'll start off with the survey. At the end of the webinar, you'll get a survey asking you for feedback. Please take a couple of minutes to complete the survey. This is your opportunity to have your say, and your feedback helps us bring you what you want. So it's very valuable. In terms of audio settings, excuse me, if you're using a mobile device and you can't hear the sound, please check your device settings. So for Android users like Samsung or Google, press the volume buttons to turn up the volume, but make sure you adjust the media channel volume. For some, it might mean pulling down on the slider at the top of the screen, but in saying that, most of you won't have any issues. For questions, if you have any questions, please send them through via the chat box on the right-hand side of your screen. You can see the chat box pictured in the slide we've got there. So unlike live events where we ask you to keep questions to the end, for this webinar, you can ask them as soon as you think of them through the chat box. Okay, we've got a short video message from our commissioner, and then we'll see you on the other side for the beginning of the presentation. So we'll just pop that video on now for you.
Hi, and welcome to the first of our new series of webinars designed for accountants who work with our QBCC licensees. You all have an important role to play in helping licensees to comply with licensing requirements. As the QBCC Commissioner, I'm incredibly proud to be able to be here today and launch this new series of webinars. While our licensees know their way around a building site, they don't necessarily always know their way around a balance sheet. Nor do they need to, because they have you in their corner and available to help them. Here at the QBCC, our job is to administer the law and to take regulatory action against those who fail to comply. But we also have an important role in ensuring industry understands how to comply. MFR laws commenced in January 2019 as part of our broader security of payment reforms. Far too often, we've seen companies collapse, go to the wall, and leave behind them a trail of destructions. We know that financially healthy and viable companies are more likely to pay their subbies and suppliers in full and on time. The construction industry has long been a place for informal arrangements, often just a handshake. Business practices in the industry have fallen well behind what should be expected or what you'd find in other industries. The intent of the MFR policy is to support stronger and more sustainable businesses, but also drive behavioural and cultural change in the industry. Today's webinar is about meeting the minimum financial requirements when a trust structure is in place. Future webinars will cover off on a variety of topics, and I'd encourage you to provide feedback or send us your suggestions on what you'd like to see us covered. Another great source of information for all accountants is our recently launched online magazine, QBCC Accounting Matters. If you haven't already had a chance to subscribe and read it, details on how to do that will be provided later in today's session. Thank you all once again for your time, and I hope you find this webinar valuable.
Great, thank you for that, Commissioner. And joining us now, we have Nat Dennis-Weller from our FAU team. Thank you, Richard, and over to you, Nat. I'll be in the background changing slides, so I'm going to disappear for now. Thanks very much.
Thanks, Harm, and thanks everyone who has joined us on this webinar this afternoon. Hopefully you'll get a bit out of it. To our Brisbane accounting colleagues, happy Friday, long weekend ahead. The gift that keeps on giving, the COVID virus. So for those of you who have heard me present before, you would know that public speaking is not my forte. Still not sure what is yet, but it's not public speaking. So we'll run through a bit of information, then hopefully get to the Q&A session at the end where it'll be a bit more interactive. As Harm mentioned, though, if you have any questions relating to trust structures, shoot them through into the chat function. And if we can't get to all the questions and answers this afternoon, we'll endeavour to provide the information to you at a later date. Although not specifically trust related, I thought I'd quickly go through the difference between annual reporting requirements and MFR reports, as there's still a bit of confusion about the different aspects of financial reporting for QBCC. So annual reporting is just that quick financial health check. For most licensees, it's their internal management accounts or a 3-page annual reporting form. No accounting standards are required, and an accountant is not required to prepare the report. We would always say it's best business practice for an accountant, for a licensee to seek advice from an accountant, but for annual reporting purposes, it's not compulsory. The annual reporting days are set each year at 31 December for mid to large range licensees and 31 March for SC1 and SC2 contractors. We know that 31 December is not an ideal day for business. Most industries are shut down over that period, but the reason that the date's set at 31 December is to allow enough time to get the financial year-end documents prepared, and at the same time provide QBCC with enough reliability to be able to look at those accounts. So they're still fresh enough for us. An annual report, on the other hand, is only required in certain circumstances, such as a license application or decreasing your NTA, upgrading your maximum revenue, or if the licensee is audited by the Commission. All prescribed accounting standards are applied for an MFR report, and the financial statements can't be any older than 4 months old. Another thing to note with the difference in annual reporting to MFR reports, unfortunately the online portal is not yet set up to receive MFR reports. The sole purpose of My QBCC is at this stage for annual reporting lodgements. As our Commissioner touched on, the intent behind the financial requirements. So all laws have an intent behind them. Our financial requirements are no different. The intent is to assist having a financially sustainable building industry so that we have builders who can withstand the peaks and troughs, who are financially sound. The requirements are in place to ensure that builders and contractors have enough working capital and liquidity, which then protects industry stakeholders such as homeowners, subcontractors, and suppliers. For annual reporting purposes, the information is based only on the trust. That's all we require for annual reporting because the trust is the trading entity. But when providing an MFR report, we need the financial statements for both the trust and the trustee. So that's a requirement under the Corporations Act to keep financial records, and QBCC doesn't have the discretion to waiver that requirement for MFR reports. So even if the trustee entity only has $2 paid up capital, the balance sheet would show assets of $2 and the P&L would show zero income. Thanks, Harm. Why does someone trade through a trust structure? Well, used to be tax benefits once upon a time, now not so much anymore. The main benefit is asset protection. The assets are held on trust, and as the trust can't be sued, it's not the legal entity, the assets are essentially protected from creditors. So remembering a few slides ago and what our Commissioner also advised, we established the financial requirements, we have already established that the financial requirements have the intent of ensuring that licensees have assets available to pay their debts. But if all the assets are protected, that kind of undermines the utility of the financial requirements. So if an NTA of a trustee company is only the $2 or only paid up capital of $2 or $10, then a deed of covenant may need to be required from a director to meet the net tangible asset requirement. If the trust is set up to protect assets, but the director still has to personally guarantee their assets to the trustee, that might defeat the purpose of setting a trust up in the first place. Just something you may need to consider when you have clients who are moving into a trust structure within the building industry in Queensland. QBCC doesn't license trusts, probably not likely that we ever will, because the trust is not the legal entity, it's the trustee. So it will always be the trustee, whether that's a company or an individual, who holds the QBCC license. The big difference with the MFR regulation now is that the trust now gets assessed under the MFR framework, and we'll get into that detail in the next slide. So the MFR regulation states that the trust assets are worked out as if a reference to NTA were a reference to trust assets, and a reference to a licensee were a reference to the trust of the trustee. Sorry, the trustee of the trust. The regulation also specifically disallows a number of items, such as intangibles or contingent assets or debtors between 180 and 365 days or debtors over 365 days. So that means if the trust records one of those items as an asset, they have to be disallowed by the legislation. If the trust records borrowing costs or goodwill, these assets, these amounts need to be deducted. QBCC doesn't have the discretion to allow any disallowed assets in calculations. It's not that we're being pedantic or we're trying to be difficult, it's that we are bound by the law when we assess the financial information provided. For an NTA deficiency, if after deducting those disallowed assets from a trust's financial position, that then leads to a negative net tangible asset position in the trust, that deficiency would flow back to the trustee. So that can lead to the trustee having a negative net tangible asset position in its own right and therefore failing the financial requirements. The trust or the trustee itself would need to be sufficiently capitalised to cover that deficiency if required. And just a quick note that a deed can't be relied upon if the NTA position is negative, and also that a deed is only used to increase the NTA position when it is in the positive and doesn't affect the current ratio position at all. And the last bit that we wanted to cover off on is that for SC1 or SC2 contractors, the legislation as it currently stands does not allow for an SC1 or an SC2 licensee to rely on a deed. Only categories 1 to 7 are able to use a deed. So that means for an SC1 entity trading through a trust structure, the trustee entity would either need to be sufficiently capitalised to have NTA of $12,000 in its own right, which kind of defeats the purpose of having a trust if those are if the assets are held in the trustee, or the SC1 entity would need to meet Category 1 requirements and rely on a deed, which they would need to increase their NTA to $46,001. Again, unfortunately, QBCC doesn't have the discretion in relation to this requirement as it is set out in legislation. Thank you. So over to some questions and answers.
Absolutely. Again, yes, thanks folks for tuning in. We've got some questions already to start with. Nat, if you're ready.
Go for it.
Folks, if you're ready, let's get started. So first question we've got here is, Nat, can you discuss the MFR position if the trust makes a loss in a particular year?
Sure, good question. If a trust makes a loss, then that loss is essentially trapped in the trust and has to be carried forward to offset against income in a future year. It cannot be distributed to a beneficiary. Hopefully that answers that question.
Great, thanks, Nat. Next question we have, does the trustee company need to have an ABN?
Oh, okay, interesting question. QBCC doesn't administer ABNs, that's the ATO, but I can tell you from knowledge within the QBCC that a trust only needs an ABN if it's conducting business. And if it does conduct business, then it's the trustee that registers the ABN in their capacity as trustee. But again, that's through the ATO.
Great, thanks, Nat.
Great question, though.
Thank you to whoever asked that question, very much appreciated. Next question we've got is, Nat, is there any differences in meeting the requirements for a fixed unit trust as opposed to a discretionary trust?
No difference whatsoever for QBCC purposes. So whether it's a discretionary trust or a hybrid trust, the same requirements are still needed to be abided by for QBCC purposes.
Okay, thanks, Nat. Just waiting for some more questions to come through. It looks like it's fairly quiet at the moment.
That either means that we've covered off on everyone's questions over the presentation, or perhaps some people are being shy.
I think possibly being shy, that might be the one. We might wait a couple more seconds just to see if we've got anything else coming through.
And again, no pressure to the attendees here. If you aren't comfortable putting your question through to a chat, or you've got specific questions, we can definitely deal with them offline through one of our contact points from QBCC.
Absolutely. Okay. Nice.
Oh, Harm, I'm taking it that our presentation was so good, it's covered off on everyone's questions.
I think you're right. I think you're right. No, nothing else coming through. Okay, it looks like it's all quiet on the Western Front, so it does appear as though we've answered all the questions that we've got so far. We might just wait for another couple of minutes just to see if we've got any other questions coming through. Okay. All right, just one moment. I think we've got some questions coming through. Apologies, folks. The system on our end is a little slow, so apologies for that. But we are getting some questions through. Let's see. Okay, here we go. I can see the wheels turning in the background. Looks like we've got something coming through.
Poor Mel and Lauren are in the back end typing frantically away, no doubt.
Yeah, absolutely. Okay, here we go. Fantastic. So, next question for you, Nat.
Righto.
Okay. Does the guarantor need to provide details of all assets they have, or only enough to meet the deed amount to cover the asset shortfall?
Oh, another great question. And it is a fairly common question, actually. So on the covenantor's statement of financial position, it does need to state the full financial position of that covenantor, not just enough to cover the deed assurance that's being assured back to the company. However, under the MFR regulation, covenantor's statement of financial position has to be accompanied by the documents that you've witnessed as the accountant to confirm ownership and value of that particular asset. We would not be looking for a bank statement for $5. We would be looking at the accompanying evidence of the material assets and liabilities. So common one, house, director owns the house or property, something to that effect. So it would be a valuation of that house or RP data search or something similar to that, whatever you've cited to confirm the value, and then perhaps the bank statements for the accompanying mortgage. But it's the accompanying evidence is only for the material items within that covenantor's statement of financial position.
Okay, great. Thank you, Nat. Once again, we're just going to wait for some questions to come through. Again, I'll just extend my apologies for the system being a little slow in getting those questions through to us. We do have another one here. Okay, so Nat, this is from Matt.
Hi, Matt.
Let's see. Meaning we write, okay, so I'm just going to read this out as it's come through. We write off the value of the assets because we can for tax purposes. how to revalue them effectively, ?
Okay, another great question, and I actually discussed this with a beautiful group of accountants earlier today, and thank you for your time if you're on the webinar. The short answer to that, and it is a fairly lengthy answer, but I'll try and keep it as short as I can. The whole reason, licensee goes out and buys a ute. It might be worth $20,000. He drives it off the lot, probably worth slightly less than $20,000 after he drives it off. The ATO allows that asset to be written off 100%, which is great. Tax concession, that's great. For obviously going back to the intent of the financial requirements, the intent is that an asset has value. You can sell that asset if you need to pay your debts. That's essentially the intent behind the financial requirements. So director or the owner of that vehicle maybe gets into trouble financially or has a debt that they weren't aware of, they can look out the window, see that that vehicle is still worth, let's say still worth around about $20,000. They can sell it and pay that debt. That's the intent behind the regulation. So in order to alleviate the difference between what's prepared for tax and the tax accounts to have that 100% concession to that or write-off to that, you could provide the financial statements for QBCC with a revaluation reserve in that to show the actual value of what that vehicle could be sold for, or what value that asset holds to that financial position. So short answer, revaluation reserve in the accounts.
Great, thanks, Nat. I'm so happy that we've got you in the session today. Your expertise is absolutely highly valued at the moment.
Thank you.
No problem. Just waiting for some more questions to come through there. I think we've got one here. Again, I can see the cogs and the wheels turning, and we should be getting something through soon.
Just while Harm's looking for some questions, don't forget, if you've got some popular topics that you want to either for us to include in our bi-monthly accountant newsletter, sing out, not necessarily in this forum, but shoot us an email or something similar. And also, I think Harm has mentioned a survey at the end of the webinar for any future webinar discussions. So whether that's annual reporting, might be MFR report, how to complete one, what we look for, pain points in that regard. So we'll essentially base our webinars on the common topics, the common pain points that we see.
Great, thanks again, Nat. And we do have some questions coming through. Okay, we've got a question from Anne. And the question is, hi Anne, if a licensee decides to vest the trust and continue trading as the company, which is the licensee? Does the QBCC need to be notified?
Sorry, just repeat that last part, which is?
Sure. I'll repeat the question again. So from Anne, if a licensee decides to vest the trust and continue trading as the company,
Yep.
Which is the licensee? Does the QBCC need to be notified?
Yes, because that would be considered a change of business structure, essentially, particularly if the entity, the company, had previously relied on a deed and it only had that paid up capital of $2 or $10, assuming that the trustee is now capitalised, that may affect the financial reporting that they've provided us. So short answer, yes, it is something that you'd need to advise QBCC of for that particular change.
Perfect, great, thank you for that. Okay, we've got another question here from Scott. Scott's asking, if a licensee who trades through a trust but later changes structure to trade through the trustee company, the licensee in its own right, is a new MFR required?
So similar to the last question, may not require a new MFR report. Don't really know that until we establish what the change of that position is. So my suggestion would be to contact either our MFR queries inbox or our annual reporting inbox, potentially float that question, and then we can provide you the correct answer in response to that. So it just depends on the nature of that change, again, whether they've relied on a deed in the past, whether the company, the trustee company, is now capitalised in its own right, that it meets the requirements. It just may change some of the reporting requirements for that particular licensee.
Gotcha. Thank you again, Nat. Once again, wheels are turning, waiting for the questions to come through. As Nat's mentioned, there will be a survey at the end of the presentation. It just asks a couple of things about basically what you want to see. So it's your opportunity basically to let us know what you would like to see, and then we can sort of customize and build information sessions and webinars to accommodate for those. Okay, here we go.
Please be kind with your feedback too.
Okay. Okay. No, we've still got the one from Scott there.
So I did, I think I mentioned before, I did speak to a firm of accountants this afternoon, and the feedback was taken on board, and hence the reason for these webinars and the bi-monthly newsletter. Shout out to my director, Omar, who I think is on the webinar as well, to push in that direction where we do need to capitalise on our communication with accountants and the accounting industry. It makes our jobs a lot easier at the back end, but it's also to open those channels of communication with the people that actually do the MFR reports on the other side.
Fantastic, thank you. Okay, let's see. Okay, here we go. We've got another question from Nira. I'm sorry if I've mispronounced it. Hopefully I've pronounced that correctly. Question from Nira. Okay, all categories need a deed of covenant. Maybe we didn't get the full question there.
Is perhaps the question, do all trusts or licensees that trade through a trust structure need to rely on a deed? Let's go with that.
Let's go with that, yeah.
So the short answer is no, because the trading entity, or sorry, the trustee could be capitalised in its own right, where it doesn't need to rely upon a deed. If the trustee company only has $2 or $10 of paid up capital, $100, whatever the case is, then it may need to look at relying on a deed from an assured, an acceptable assurer, which is usually the director.
Perfect, thank you. Okay. All right. Still waiting for more questions. And of course, thank you, folks, to the folks that have already sent through those questions. Very much appreciated.
Definitely.
Please keep on sending them through. And like we mentioned before, if we're unable to get to those questions now during the session, keep an eye out on the QBCC YouTube channel and also the QBCC website for a recording of the webinar as well. So that will be provided. Here we go. We've got another question by the looks of things.
We'll also be able to, we should be able to add the Q&A information to the next newsletter as well.
Yeah, absolutely, absolutely. Okay, ticking over. Actually, we've got, no, let me see. We've got Andrea asking, can you go over that again? Trustee needs the NTA amounts but if you do an MFR, you need to lodge the trust accounts as well.
Okay, sure. So for an MFR report, both sets of financial statements are required, and QBCC doesn't have the discretion to waiver the requirement for the trustees' financial statements. So the reason for the two sets of statements, the trust and the trustees' financial statements, is to calculate the combination current ratio, because it's if I can get my words out, calculated on the current ratio and current I really can't get my words out. The current ratio is calculated on the current assets and the current liabilities of both the trust and the trustee. The net tangible assets is based just on the trustee, but if there is a deficiency in the trust, then that needs to be taken into consideration. So financial statements for the trust and the trustee may only be for that paid up capital of $2 or $10. So the balance sheet would show $2 or $10 assets, and the P&L would show 0 for the trustee.
Let's see. I've got a question here. How likely are you to cancel the license of a trustee if the NTA is negative?
So,
sorry, I'll repeat that again. I was just on mute. Sorry about that. I'll just repeat the question. How likely are you to cancel the license of a trustee if the NTA is negative?
So good question. Being a risk-based regulator, we have been for quite some time, we look at the risk to the industry of taking action or not taking action. So we weigh up what the risk is. Obviously, the larger the licensee, the higher the risk, because it would be quite catastrophic for a large licensee to fail. They would leave a number of subcontractors, suppliers, homeowners up in the lurch. Compared to a smaller licensee who may not have trade accounts of their own, they may not have subcontractors of their own, the risk would be lower. We also look at things like, are there any monies owed complaints? Are there any solvency concerns? Are there any defective work claims? So we weigh all of that up. So it's not just the financial information for that licensee, it's whether they are trading within their maximum revenue, the amount of their actual revenue that they're doing, has there been previous losses within that company? Essentially, are they tracking okay? If not for that one glitch that they have a negative net asset position, are there any other concerns that we need to consider before we take action or not take action? So how likely? I can't give you that answer. We weigh it up based on the information that we know.
That's fantastic. Thanks, Nat. Okay, so now we've got a question from Amanda. Can an accountant in public practice acting for a client for tax purposes also sign their MFR report, or does it need to be signed by an independent accountant?
So that is more of a question for your accounting industry body. I believe CPA don't like the same accountant to sign off on those. We don't have any issues with that. The MFR report just needs to be, if it's a category 1 to 3, we will accept a compilation engagement on that. We need to ensure that the MFR regulation has been applied to that, those financial statements. So it doesn't necessarily have to have a different accountant completing each of the documents. That's not a QBCC requirement.
Great, thank you. Okay, now we've got another question here from Amy. Hey, Amy.
Hi, Amy.
Could you please cover treatment of associated director loans? Can they be considered an asset?
Okay, another good question and a common question. Let's start with the negative to that, liabilities. So related entity liabilities cannot be deducted for any reason, always have to be included in calculations. And that is also including directors' loans liabilities. For an asset, if it's a related entity loan asset, whether it's to the director, to another related entity, whether you include it in calculations is dependent on whether the amount is material to that licensee's financial position. So it can be included as the asset. It doesn't have to be included as an asset in the calculations. If you are relying on it to meet the current ratio requirement or the NTA requirement, that related entity does need to comply with the test that's set out in the regulation. And by that, it is the related entity also through the same MFR framework, so any disallowed assets have to be deducted. That related entity has to have a current ratio of 1:1 and NTA of at least 0, so the NTA can't be negative. If that is the case, the asset can be included in calculations, but again, if it's not material or you don't want to provide the supporting documents to that of the related entity, it doesn't have to be included in calculations. It just depends on whether it's material to that licensee's position. And just recapping again, related entity liability loans have to be included at all times.
Thank you. Seems pretty clear. We've got another question from Amy, or it might be a different Amy, I'm not too sure. If a licensee exceeds their turnover threshold and needs to apply for an increase on their license, what is the time frame it is required to be lodged by? And if they do not do it in time, what are the consequences?
Okay, I don't have a real solid answer for that. The time frame to provide the MFR report is as soon as you become aware of the breach. So the licensee would hopefully be recording what their turnover is looking like for the coming year. I would suggest that they lodge that MFR report if they know that they're likely to breach the maximum revenue amount. And what are the penalties if you don't? You can be issued a fine if you do trade outside of your turnover, but it's more likely that the Commission would issue an audit or a show cause notice if we do become aware through the annual reporting requirements that the maximum revenue amount has been significantly breached.
Fantastic, thank you, Nat. Okay, let's see if we've got any more here. Okay. Let's see, we've got one here from Tanya. When providing the financial statements, should accountants remove the compilation report? I'm not too sure if you know what that means.
That's entirely a matter for you. If it's provided with a category 1 to 3 MFR report, it's totally fine. There's no conflicting statement there. For a category 4 to 7 MFR report, it is a requirement that the financial statements are based on a review or an audit engagement. So there would be a conflicting statement there under the compilation statement. For annual reporting purposes, not an issue at all. It's not relevant.
Great, thanks, Nat. Another question from Kelly. If there are disallowed assets in a $2 trustee company, there will never be a situation where they meet the NTA requirements of the MFR. Are there any practical guidelines on how this is treated? Can the negative NTA position be absorbed by a reserve such as the asset revaluation reserve that you just mentioned?
Yes, so that would be the solution or potential solution for that particular trust. But I'm imagining that you would provide those financial statements showing the revaluation reserve, not showing the negative net tangible asset position without that revaluation reserve, if that makes sense. So you wouldn't be providing the financial statements to QBCC showing that the motor vehicle was worth 0. You'd be showing that the motor vehicle has been revalued in the equity under the revaluation reserve. The other option or the other solution, the trustee company is sufficiently capitalised in its own right to absorb that deficiency, but how you actually do that and the mechanics of that is not something that we would weigh into. We don't give business advice because it has ramifications for your clients, tax ramifications and things like that, that would be totally separate to QBCC's requirements.
Great. We've got a question here from Ari. Can the annual report be a date other than 30 June?
It's based on the licensee's most recent reporting year or financial year. Usually licensees have the financial year end date of 30th of June. It would be extremely unlikely for a mid-range to low-range builder having a financial year other than ending 30 June. Most requests that we receive are from international or even maybe national companies who have the financial year end date 31 December. That's so far only around about 11% of our total licensees that have a different financial year end date.
Great, thank you. Okay, so we've got a question from Katie. Hey Katie, if a trust owes a beneficiary funds, is this included as a liability, and is it current or non-current? Also, if the beneficiary owes the trust funds, can it be classed as an asset? And then in brackets it's got C/NC, confirm, non-confirm, I think.
Current or non-current, okay.
Current or non-current, there you go, okay.
Yeah, so I'll split that into the two answers. For the liability, unless the trust has an unconditional right to defer settlement of that amount, which would be set out in the trust deed, then under AASB 101, it should be recorded as a current liability. So you just need to be aware that that may affect the current ratio. So unless there is that unconditional right to defer that settlement, it's not whether or not the beneficiary ever wants to call up on that liability, it's whether or not they have that unconditional right to defer that settlement. That's the liability side. The asset side, yes, it can be included as an asset, again, if it meets the current ratio, if that party, the beneficiary party, classed as a related entity, if they have current ratio of 1:1 and NTA of at least 0, then yes, it could be included as an asset for that trust. Doesn't necessarily have to be included in calculations if it's not material.
Great, thank you, Nat. I'm just waiting for some more questions to come through there. All right, we've got one here from Jen. How are related party loans treated? Question mark. Current or non-current, i.e., directors' loans and beneficiary accounts, etc.
So assuming that you're referring to the asset side, not the liability side, whether they're payable within or payable or receivable within that 12-month period, will establish whether or not they're a current asset. If they're not, then it would be a non-current asset.
Great, thank you. Now we've got a question here from Stephen. I'd just like to clarify, are net assets of the trustee included in the net tangible assets figure that gets reported on the annual reporting form?
Yes, so for annual reporting purposes, it's the trust's financial position that is included in the annual reporting information. So separate to an MFR report where we look at the combination of the trust and the trustee for current ratio, and then look at the trust's NTA position. If it's negative, it needs to flow back to the trustee. For annual reporting purposes, you only need to report on the trust structure as the trading entity.
That's great.
And I think if you're logging the annual reporting lodgement via my QBCC portal, or if you're filling out the manual form, it will establish one of the questions: what structure do you trade through? You just tick that you trade through a trust, so that we're aware of that.
Great. We've got a question here from Chris. Hey, Chris. If a trustee company has issued 50,000 shares at $1 each, the accountants can sometimes reflect this as cash on hand. How do we as accountants or QBCC verify that for an MFR?
So I can't imagine someone carrying around $50,000 of cash. If it's cash at bank, it would be a bank statement. Otherwise, it may be a related entity loan that the director has paid is owing. So it just depends on the actual calculation of that. What you would, if it is recorded in the financial statements as cash on hand, I would be requesting something to verify that position from the entity, from the licensee.
Great. We've got a question from Sharon. Okay, she starts by saying, you mentioned about borrowing costs being intangible, which can result in a deficiency for the trust. Under the accounting standards, it says the borrowing costs associated with the acquisition of an asset are part of the asset cost. So can we consolidate this cost in the cost of the asset in the depreciation schedule, or should it always be separated out as a borrowing cost?
So if it is recorded as a borrowing cost, it needs to be deducted. How you record that is really a matter for you and your client. It's not specific. A borrowing cost is not specifically listed as an intangible asset in the MFR regulation. It's that the MFR regulation states that the particular accounting provision that deals with income taxes is classed as an asset that can't be included in calculations.
Great, thanks for that, Nat, and thanks for the question, Sharon. Let's see here. We've got a question from Ari. For a gift of an asset into a trust by a beneficiary, so that the trust does not owe the liability back to the beneficiary for
Yep.
the gift, will this asset count towards the NTA?
Yes, it would. So I'm guessing that the asset, the gift, might be a motor vehicle, might be cash. They're all classed as assets. So yes, if it's not a loan and it doesn't have that corresponding liability, the director or beneficiary has gifted the cash or gifted the motor vehicle to the trust, then yes, it would be included as an asset or could be included as an asset.
Great, thank you. And we're still waiting for questions to come through. Here's one from Anne. When is a deed of covenant needed? Can an SC1 or SC2 category license rely on one?
So they can rely on a deed. It just means that they, unfortunately, under the legislation, they need to bump up to a category 1. So they would no longer be an SC1 licensee. So under the legislation, only categories 1 to 7 can rely on a deed, and deeds are only used or only relied upon to increase the NTA position. So it can't be used if the NTA position is negative and doesn't go towards the current ratio requirement.
Great, thank you. Okay. Here's one from Brendan. I'm not too sure whether we've got an answer for this one, but we'll throw it into the ring anyway. Who came up with the rule for a corporate trustee? Who came up with the rule for a corporate trustee is required to prepare financial statements? I'm sorry if I've read that wrong. Seems obsolete if only has cash on hand and issued shares.
So that's a Corporations Act requirement. As I said, QBCC doesn't have the discretion to waiver that requirement. That particular entity or PTY Ltd is obliged to keep financial records. So it may seem silly to provide a balance sheet with $2 and a P&L of $0, but it isn't a requirement under the Corps Act that those financial records are kept.
Okay, question from Riley. With relation to one of the first questions, if a trust makes a loss in a year, it effectively will put the trust into a net negative asset position for that year. How will that affect the annual reporting license for that year?
So if it's provided for annual reporting purposes, again, it depends on the risk to the industry of that particular licensee. If the trust shows a negative position and there are other concerns, money's owed complaints, defective work, they might be trading outside of their turnover, then some questions may be asked from QBCC. Otherwise, if there's no risk to the industry, we may take a different approach to that position.
Great, thanks, Nat. And just quickly, just to reassure everyone that's sending through questions, we will get to those questions as soon as we possibly can, if we're unable to answer them during the webinar today. We've got another question here from Richard. If a trust has income as an unpaid present entitlement, how is this treated?
Income from an unpaid present entitlement?
Yeah, so the question again, if a trust, and this is how it's just come through, if a trust has income as an unpaid present entitlement, how is this treated?
I'm assuming that you mean an unpaid present entitlement as an asset of the trust. So that would be included as an asset of the trust if that amount, if that beneficiary is able to show that they have the current ratio of 1:1 and NTA of at least 0.
Great. Okay, thank you. Question from Nola. Do you include in the income
Hi, Nola.
Hi, Nola, sorry. Do you include in the income turnover value on the MFR the revaluation amount of the revaluation of assets?
Oh, not that I'm aware of. No, it needs to be in the balance sheet in equity and the revaluation reserve shown there.
Perfect, thank you. Okay, another one. I've got a question from Raymond. Why do you accept the liabilities of the trust but not the assets of the trust? Surely it goes both ways.
So that's not actually correct. It's just that no liabilities can be deducted from calculations. Some assets have to be disallowed under the legislation, and some assets don't necessarily have to be included in the calculations to meet the NTA if they're not material to that position. So, example, related entity loan showing as an asset. If it's not required to be relied upon to meet the current ratio or the net tangible asset test, you have the option under the MFR report to say that it's not being relied upon and that particular amount is not included in the calculations if you don't need to or if you don't want to. If it is included in calculations, it needs to meet the related entity asset loan test of 1:1 and NTA of at least 0. So it's not that they're treated differently, it's that related entity, liabilities under either the trust or the trustee cannot be deducted, whereas an asset can be included in calculations if it is needed to or if you want to.
Great, thank you once again. Just waiting for more questions to come through. Let's see. All right, we've still got the one from Raymond there. Just to reiterate once again, for all the questions that are coming through, we will get to them as soon as we possibly can. And the wheels are turning at the moment just with those questions coming through. So
Hang tight.
hang tight, that's right, thank you. Let's see. I think we've got that one. This is a slightly longer question. I can see, well, actually, this is a very short question we've got from Jen. What is the relevance of a cash flow statement for SC1 and SC2?
An SC1 and an SC2 are not required to provide cash flow statements unless they're providing the MFR report because they have to bump up to a category 1. So in general, cash flow statement not required for SC1 or SC2.
Okay, I think we actually we had another question through from Robert, which was exactly the same question, which was, what is the relevance of the cash flow statements for SC1 and SC2? So Robert, I'm pretty sure that question was answered right there for you. Okay, let's see. All right. Let's see, we've answered that one. Robert's question has been answered. Well, it's going a little quiet here. Oh, no, we've got some coming through. Here's a slightly longer question from Nola.
Hello again, Nola. I think I know Nola. I've met Nola a few times.
Nola asks, from our research, when we do the revaluation, it is DR assets. I'm hoping that makes sense to you.
Yeah.
DR assets for revaluation and credit income account. So that is what I mean for including the income in the turnover figure. Maybe that was just a statement that Nola was sending through for us.
Sure.
Thanks, Nola. Here's a slightly longer question. No. Okay. We've got one from Shane. Why don't QBCC accept goodwill that has been physically paid for example, via a business purchase? By not accepting this, it puts the license in a negative position for NTA.
Yes. So as we covered off on earlier, we don't have the discretion to be able to allow intangible assets in the calculations. The legislation is quite clear on that point. It provides a very strong list, very defined list within the regulation of what can be included in calculations and what cannot be included. Again, it's not that QBCC is trying to be pedantic on goodwill or difficult on goodwill, it's that the law says we can't include it in calculations.
Great, thank you, Nat. Okay, we've got a question from Dallas. Please confirm, Dallas asks, please confirm that all beneficiary accounts in liability to the trust must be classified as a current liability, ? This seems unrealistic given the trustee has the discretion to treat this as a non-current liability.
Yep, so it's not a definite either way. It comes down to whether or not there is an unconditional right to defer settlement of that account, of that amount. So going back to the trust deed, it depends on what's set up in that trust deed or a similar legal document. So there needs to be an unconditional right to defer settlement in order for it to be classed as a non-current liability.
Great, thanks, Nat. Let's see. Question here from Shelley. We may have covered this before, but I'll ask it anyway. Can a deed of covenant include the interest in another trust as an asset? And if so, does the other trust need to satisfy the NTA and current asset ratio as well?
Okay, can you just repeat that question again?
Yeah, sure thing. Okay, from Shelley, can a deed of covenant include the interest in another trust as an asset? And if so, does the other trust need to satisfy the NTA and current asset ratio as well?
Yes, the answer is yes to both of those. So yes, it would be the trustee that is likely to rely on that deed because perhaps it's the trustee that only has the paid up capital relying on, if I'm remembering the question correctly, Harm, start the question again. Can it?
Yeah, sure thing. So the question is, can a deed of covenant include the interest in another trust as an asset?
So I'll just stop you there. Another trust's assets. So a deed can only be provided to the trustee company, not a trust to a trust. So there are only certain acceptable assurers that can provide a deed to the licensee or to the trustee. So that would need to either be a beneficiary of the licensee of the trust, or a director, or a related party, like a related body, corporate. So I'm not entirely sure of the question of when you say it's another trust relying on the covenantor. So it's not the trust that relies on the deed, it's actually the trustee. But breaking that question down a bit, another trust's assets on a covenantor's financial statement of financial position can be included, but yes, it would need to meet that the test under the MFR regulation, current ratio of 1:1 and NTA of 0, at least 0.
Fantastic, thank you, Nat. We've probably got time for just a couple more questions.
Yep.
Let's see, let's go with one from Jen. Jen asked, and we may have covered this again already, how are related party loans treated, current or non-current, i.e. directors' loans? We have covered that, and beneficiary accounts, etc. We've gone over that, that's fine.
Yep.
No problem. We've got one here from Scott. Does a related entity net asset position take off the liability owing to the licensee as their own related entity liability? To work out if they haven't at least, it's a very long question. I apologize if I'm butchering this, Scott. We might actually, I'll just put that on hold and we'll see if we can pop that through to the folks who've got furiously typing away in the background, and we'll go to a question from Joyce. Joyce is asking, are loans to beneficiaries classified as a non-current liability included in the current ratio?
Okay, say that one again. Are related entity assets owed by beneficiaries? Owed to beneficiaries, sorry.
So what is it? Are loans to beneficiaries classified as non-current liability are they included in the current ratio? Again,
No. So if they're correctly recorded as a non-current liability, then the non-current liability as it stands is not included in the current ratio, because the current ratio is current assets and current liabilities.
Great, thank you, Nat. And we might have time for just one more question, and we'll see if we can squeeze this in. From Andrea, for the statement of financial position for the covenanter, do they have to include shares/beneficiary positions in other entities?
So the covenantor's financial position is their full financial position. So yes, it would include that. Whether or not it's material to the financial position, we would need to work that out. And then the supporting documentation recorded for that.
Okay, fantastic. All right, folks, we do still have lots of questions coming through. As we've mentioned a few times during the webinar, we'll do our best to get to all of those as soon as we possibly can.
Definitely, yep.
Yeah, okie dokie. All right, well, thank you to Nat. Huge thanks to Nat, Mel, Lauren, and Joss, and everyone involved. Big thanks to you folks, and thank you to everyone who has attended as well, and everyone who has submitted questions. We really appreciate your participation and feedback. Remember, if you'd like to subscribe to the QBCC Accounting Matters online publication, you can send an email through to MFR Queries. That's MFRQUERIES at qbcc.qld.gov.au. I believe that should be coming through to you via the chat, so you don't have to write that down. Also, keep an eye on the QBCC website or YouTube channel for a recording of the webinar. Just finally, we're also excited that the new QBCC website is launching soon. So content on trusts and MFR reports will be finding their way into those pages. Once again, don't forget to complete the survey. And on behalf of the QBCC, I'd like to thank Nat once again. And thank you all. Thanks, Nat. It was really great. And thank you all once again for taking the time out of your busy day. And we expect the information we've provided will assist you and your clients understand with greater clarity the requirements for reporting trust information for MFR reports. Folks, thanks once again, and we'll see you at the next webinar. Cheers.
Thanks,
and bye
everyone.
for now. Thanks. Bye-bye.
Bye.